Welcome to our session on information frictions in crypto markets. I think it's worth taking some perspective about what this session is about, right? So, when you read Nakamoto's white paper, which is all about creating a decentralized database that can be shared among people, would you have forecasted that the major billion-dollar industry it would spur would be a bunch of centralized exchanges, letting people trade these decentralized cryptocurrencies? Maybe not. But I think there are lots of reasons we can guess this may have happened, but it's big business and people are making fortunes on creating a centralized marketplace to let people trade these. I think what's fascinating about this is that the names of the players entering this space are new. They have names like Coinbase or BitMEX or Binance or FTX, or related to our last paper, they have names like Uniswap and SushiSwap, where we're actually now trying to innovate these markets in ways that are truly decentralized. And what's fascinating is these new players don't look like traditional players in the marketplace. They don't look like Chicago Mercantile Exchange. And so they're very different. And I think a lot of what this session is about is seeing what we can learn by looking at how these exchanges behave and what evidence we see from them, okay? Now, a lot of the focus today is on volume on these exchanges and what we can learn from volume, but I think it's important to understand the variety of ways these exchanges look different than traditional exchanges. So a lot of today we'll talk about spot markets in this session, but these exchanges are innovating in lots of fascinating ways in terms of offering complex derivative products that people can trade. They're attracting a strange mix of retail customers, traditional institutional investors, and new upstarts institutional investors in the crypto space. Do we need to be concerned about how they're bringing all of these different people together is a first order question for policy. And I think the papers in this session are helping us understand kind of what we need to be worried about and what might be some first order concerns. The other ways they compete, which is fascinating, is the data availability they provide. So in the centralized setting, these exchanges, I think through their desire to gamify investment in crypto markets, have leaderboards that become publicly accessible databases of how traders are performing in the marketplace. This is a feature some of my co-authors, Nicholas Kristen, Brian Rutledge, Kyle Soska, and I have exploited to get data on some of these major centralized exchanges ourselves. Their leaderboards for folks in this room are amazing sources of study to understand what these exchanges are doing. Do we need to be worried about gamification? It's a big deal. And in fact, as we'll see in some of the papers today, there's gamification among the cryptocurrency exchanges. So there are now leaderboards of cryptocurrency exchanges by volume. And you might naturally consider how that motivates exchanges to create quote unquote fake volume to drive interest in their exchange, okay? And so given all of this data, I think it's worth thinking about what our papers are gonna try to tell us. And so our first two papers are, I think, both quite related and interesting in understanding exchanges and whether they are faking volume on their exchanges. So the paper by Kong, Lee, Tang, and Yang are gonna start with that basic forensic investigation. To what extent do we think exchanges are creating fake volume, presumably to drive traffic to their exchanges? I think the open questions here are, who do we know who is creating the fake volume? And if it is the exchange, what are their incentives to do so? What is the business model of the exchange? Again, I'm worried when I think about, worried's the wrong word, when I think about these new upstarts, is their business model the traditional one where they're making money on transaction fees? Or, should I be worried about Binance is actually learning from all the information from other traders and trying to make money on that? So as we nudge out of this, I think it's worthwhile thinking about what are the business models of these exchanges and do they look like traditional ones that we're used to thinking about? I think the paper by Amaran, Leandres, and Ribetti actually provides a really nice perspective on starting to make headway here because they're trying to understand how competitive forces drive exchanges to fake volume. So they're helping us understand better of what are the motives of exchanges to look different or undertake activities different from what we're used to seeing. And what I think is really perplexing and fascinating is our last paper by Hu, Markovich, and Zhang by Sarit here, because now they're taking the next step in terms of what these exchanges for swapping decentralized currencies might look like. And they're actually looking at people getting leveraged collateralized loans from MakerDAO's lending platform to effectively bet on cryptocurrency prices. And so I think this is the kind of new frontier of where cryptocurrency exchange is going. And so I'm really excited to see what everyone wants to share today. And so with that brief introduction, I'm going to turn the floor over. Shi, I believe you're going to present to our first paper.
Okay, thank you, Andrew. And I'm gonna share my screen. Let me share. So can you see my screen? Okay, great. Thank you. Hello, everyone. I'm Shili from Newcastle University in the UK, and thanks organizer for holding this session. And it's really exciting. So thanks everyone attending this session. So today I would like to share our latest work. It's about wash trading in cryptocurrency exchanges. And this is a joint work by our Professor Tong from Cornell University and Dr. Yang and Professor Tang from Tsinghua University and me. So the first question is, why we're interested in cryptocurrency industry. So first, we know cryptocurrency industry is no doubtly the one of the fastest developing industry in recent years, and it has reached to a very sizable market, and with daily volume 100 billion. So it's a half about Nasdaq, and more public traded firms get exposed to crypto industry, and most famously being Tesla. But with those being said, this industry as a whole is highly unregulated, and there is the community itself is open source community, so it lowered the barrier of entry, and also the regulation in crypto industry varies dramatically. So you could see in US it has a regulation like the New York State Department, they have regulation which is most stringent for the crypto industry, but in the other world maybe there is a regulation vacuum. So that creates the regulation vacuum, creates the regulation arbitrage for the entrance. And last but not least, innovations are happening in this industry very rapidly. So previous year, the hottest topic is initial coin offering, but this year, the hot topic is decentralized finance or NFT. So it's hard for us to catch up, even you follow the news every day. So for regulator, they're struggling to keep up with the growth in crypto industry. So in this situation, we think crypto exchanges are a very good point to start because in cryptocurrency industry, crypto exchanges, they play a dominant role. To some extent, they function as a complex of trading platform, banks, clearinghouse, and exchanges. And crypto exchanges, they usually hold substantial funds from users' account, but many exchanges are without proper insurance or custody. So that raises the severe concern. So that's why you could see from news article that regulators from around the globe really took serious action against exchanges this year. So our study focused on the industry-wide phenomenon in crypto exchanges, which is wash trading. So wash trading is still largely unsolved nowadays. So what is wash trading? That's our first question. So wash trading refers to trades which is fabricated by single entity. They play the role of both buyers and sellers. So for the sole purpose of pumping up the trading volume, it is illegal in traditional financial markets for the reason of manipulation and tax evasion. But in crypto industry, there is no regulation. Therefore, many exchanges, they do wash trade for economic incentive. Actually, users have been dodging this for quite a long time, but after the closure of some exchanges, a CEO or previous management, they had been convicted of wash trading in media, and they called specific trades as well. There were some researchers that using this kind of anecdotal evidence to file reports, acting as whistleblower. But we're the first academic work to adopt well-established statistical law and behavior regularity to tackle this problem. And after our work, we saw some industrial change. For example, CoinMarketCap. It's a widely recognized third-party platform. So CoinMarketCap previously ranked exchanges by volume, but after our work, it changed its ranking standard. And we also see some law enforcement confirming our findings. So why exchange do wash trade? Because they have economic incentive. So trading volume helps exchanges do customer acquisition. It shows an image of popularity and liquidity. So large volume could help exchange climb up on ranking website, and most of the customer, they don't have much information about crypto exchanges. They highly rely on this ranking website to choose the exchange. So so when the exchange are ranking higher, so you could see more and more traders would come to the exchange with high rank, and the clients, they pay a fee, and that contributes high revenue for exchanges. For wash trading, some exchanges, they do it on their own, but some introduce incentive plan to reward user to wash trade for them. So in this paper, again, we adopt well-established statistical law and behavior regularity, and we use this law, statistical law and behavior regularity as benchmark, and we examine whether the crypto exchange, they follow the empirical pattern observed in traditional financial markets or law in general. So we'll talk about the methodology later. So what we find, so in our paper, we find evidence that unregulated exchanges, they do wash trade. So how severe? Based on our estimation, the average fraction of wash trade is 70%. So it's in dollar amounts, that will be around 2 trillion per month. And we also examine which type of exchange is more likely to engage in wash trading. And we also investigate the impact of the wash trade in price and ranking. So, yeah. So our data, our sample includes high frequency trading data of 29 exchanges, and the exchanges are classified as regulated and unregulated ones. So the regulation we use as our main regulation categorization is the bid license. So the bid license is issued by New York State Department of Financial Services, and bid license is the license for company providing crypto services. So bid license is crypto specific license, and it is among the most stringent license in the world. Another reason that we choose the bid license as the main categorization is because the US is now playing a dominant role in cryptocurrency industry, in blockchain industry, especially after several Chinese government ban. And for each,
we are not seeing the slides. Is it in purpose, or stop sharing the slides?
Oh, really? Oh, sorry.
Yeah. Just now, we haven't seen like this currency slide.
Oh, yeah. Let me check. Yeah, let me share my screen again. Sorry.
It looked like it was a feature. This was when you were talking about bit license. The screen went off to focus our attention. So
oh, sorry. Yeah. Let's talk about bit license again. Sorry to bother you. So, yeah, bid license is issued by New York State Department of Financial Services, and it is a crypto-specific license. It's issued for companies providing crypto services. It is among the most stringent license in the world. And another reason that we select the bid license is US is playing a dominant role in cryptocurrency industry. So for each exchange, we focus on 4 major pairs, cryptocurrency pairs. So Bitcoin, Ethereum, Ripple, and Litecoin, they're all most popular and most traded cryptocurrency. And our sample period is 4 months. And we also collect exchange-related data from both official website and data tracking platform. So for example, the coin market cap, we collect the ranking. This ranking previously is based on trade volume, and the similar web and Alexa, they provide ranks on web traffic. Okay, so now let's talk about the methodology. So the first statistical principle we use to detect wash trade is Benford's law, or so-called first digit law. So Benford's law has been effectively applied to test the reliability of naturally generated data. So it is used to diagnose the presence of manipulation or irregularities in data set. So in nature science and in social science, you could see a lot of the paper use the Benford's law to detect the irregularities. So for example, they use the Benford's law to test the population or the growth, the GDP. And it has been used in forensic study to detect fraud in tax or accounting. So in this study, we check the first significant digit of trade size and examine whether the distribution follow the Benford's law. So for example, in this figure, so the right dots represents the distribution of Benford's law, and the probability of 1 being the first significant digit is around 30%. So the probability decreases as the digit increase. And the blue bar represents the distribution of one regulated exchange, and you could see it closely follow the right dots. So which means the trade size distribution of regulated exchange, they follow the Benford's law. But the right and the green bar, you could see it's there is a violation, and there represents the trade size distribution of unregulated exchanges. So violation here are clearly spotted. So it's a sign of fabricated data. And this violation appears in all trading pairs and a lot of unregulated exchange. And in the paper, we also quantify the deviation from Benford's law statistically for all trading pairs of all crypto exchanges, and the results confirm our finding. So the second technique we applied is rounding and clustering. So it is a classical behavior regularity. So human has tendency to use round numbers. So it's a rounding. So human use round number as cognitive references. So for example, when we trade, right? So in trade size, we're probably going to type 1.3 as a trade size rather than 1.123. We don't use that too many decimal. So if all investor, they do this, right? So if all investors, they have a tendency to use a rounding number, so clustering will be shown as a bias in micro pattern of the data. So that's why you could see a lot of the clustering in traditional financial markets. However, bots or trading program, they do not show this bias. They do not have tendency to use round number. And based on this regularity, so crypto exchanges which intend to wash trade are more likely to use bots. So in order to save manpower, and therefore we expect exchanges that wash trade exhibit different patterns regarding clustering. So this figure shows the trade size distribution of exchanges, and we highlight the bars and to round trade size. So we can see that the first row is the trade distribution of the regulated exchanges. So you can see the dark gray bars are higher than the neighboring bars. So this reflects clustering. However, on the unregulated exchanges, yeah, they're the bottom two, there are no noticeable peaks and round trade size. And also the downward slope, this is also naturally observed in regulated financial markets, right? So intuitively, large orders are less frequently placed and executed. So that's why you could see downward slope in traditional financial markets. But on unregulated exchanges, sometimes you're gonna observe this strange shape. And in paper, we also conduct student t-tests to compare the trade frequency and run trade size against the ones around them. And the results confirm our finding. So the final test, we focus on tail distribution of trade size. So previous literature, such as the GABEX 2016, they explain how power law manifests themselves in city size, firm size, stock market movement, and many studies on trading volume or on trade size, they have shown that a vast majority of the tail exponents lies in Pareto level range, which is from 1 to 2 for traditional financial asset and for Bitcoin. So in this study, we first examine whether the tail distribution follows the power law, and next we examine whether the tail exponent lies in the range in this Pareto level region. And if you see the figure, we plot tail distribution in log-log plots and apply two methods. One is the ordinary least square, and the other is a maximum likelihood, which is called a Hue estimator. And in log-log plots, we fit them with power law model. So the blue line and the right line represents the line predicted by power law. So a good fit of power law should display downward linear tail. So all the regulated exchanges, they show linear decrease and closely fits the line predicted by power law. While on unregulated exchanges, the tail distribution display very irregular pattern across cryptocurrency and across exchanges. So sometimes you can observe like curvy or step-like decay. So this indicates the presence of irregular data. Okay, so from the previous three tests, we know that unregulated exchanges, they have huge data abnormality from regulated exchanges, and it's different from the one in traditional financial markets. So next, we quantify the degree of wash trade by estimating the abnormal portion of non-rounding parts. We can see from our calculation, the average, on average, wash trade percent of unregulated exchanges around 70%, and this number is in the same order of magnitude as the estimates from Wall Street Journal and industry reports. And also 70% of Wall Street's volume based on our estimation could move unregulated exchange up to average 46 position on ranking website. So we also sum up all the three test results for another measurement of wash trade degree, so which is the percentage of field test. So you could see for most unregulated exchanges, they fill at least one test in one cryptocurrency pair, and grouped by cryptocurrency. Small trading pairs like repo, they have higher percentage of field tests, but the difference is not significant. And we then investigate.
Start wrapping up.
Can you see it clearly?
We can see it, but I think you should take another minute to try to wrap up.
Oh, sorry. Yeah. And we then investigate which type of exchange is more likely to wash trade. So exchange with shorter establishment, which is younger exchange, and exchange with smaller user base, they're more likely to wash trade. And that's consistent with incentive of wash trade, because wash trade is shortcut for them to increase brand awareness and acquire clients. And we also examine how market dynamic affects wash trading, and we find if market experience recent high return or low volatility, and the exchanges, they tend to wash trade in the following week. And about the price impact, higher wash trade volume could drive up the contemporaneous price of the exchanges, but this effect won't last long. The price will reverse in the following week. So in summary, regulated exchanges, they show similar trade pattern as the trade pattern in traditional financial markets, while unregulated exchanges, they exhibit divergent trading behaviors. But based on the data provided by CoinMarketCap, regulated spot market only constitutes less than 1% of total transaction volume in crypto markets. So as our results show, wash trading is an industry-wide phenomenon, and wash trading on unregulated exchange, we think is a first-order problem, and much more has to be done in terms of regulation. And our finding imply that regulation do matters. Regulation have a direct impact in supervision and could control manipulative activity. And because the high costs and consequence of doing so, so regulated exchanges, they do not wash trade. And also a regulation can be a screening tool to separate good from bad exchanges. So good exchanges, they need to keep performing after getting license. So we offer initial side of a tool to help regulators to unveil wash trading and to combat unethical behaviors of crypto exchanges. However, this battle needs to be fought consistently because wash traders, they always learn from this. They improve their algorithm after reading this article. So that's all for crypto wash trading. Thanks for listening. Thank you.
Thank you, Shi, for that interesting paper. I think in the interest of time, we'll go to Daniel. I think I'm sure she is happy to take questions in the chat. So our next is Daniel.
Yeah, I'm gonna stop share. Yeah.
All right, let me share my slides. May I start? Ariel?
Yes, go ahead, please.
All right, great. So I cannot think about a better way to start a paper after Shirley presents hers, and great talk. And thank you, Ariel, for the introduction. And this is a joint work with Dan Amarian and Evgeny Leandris. And I'm quite excited to present it. As a financial economist, we often concern whether this is very interesting settings can actually help us learning something broader questions in finance. And I think here we're achieving that. So what we do, we look into whether crypto exchanges actually respond to competition by faking volume. Now, what we know from the vast literature in industry organization is that product quality is an important element of operating strategy of firms producing experienced goods. And I recall experienced goods are those in which the consumer realize the quality just after buying it. Now, there's some moral hazard incentives in a trade-off where product quality can be decreased, the firm can decrease product quality in order to boost short-term profits, and that often comes in an expense of a long-term costs to damage reputation. Now, how competition affects this trade-off is ambiguous because on one hand, perception of lower future rates associated with the reputation costs going down and incentives for deteriorating product quality. But on the other hand, it also increases consumers' outside option. It's easier to move to a competitor, and with that increases reputation costs, and so those incentives to deteriorate product quality are gone. So essentially, the answer to this trade-off is empirical. However, there's not much empirical work out there. Those that we are aware of associates product quality increase with competition. The best of our knowledge, Becker, Milburn, JFE 2011 shows otherwise that on experienced goods, product quality goes down. So what we do here, we bring to the table this fascinating setting on the crypto exchange trying to answer these questions. There are several reasons for doing so. Due to the limited time, I will present two. First, it's very easy for a crypto exchange to mislead consumers because there's essentially a web-based platform. On the other hand, traders may perceive volume as a signal of quality or market depth, liquidity. And as Ariel said, the web aggregators, they rank they rank crypto exchanges by volume, and that generates endogenous incentives for smaller crypto exchange to fake volume and gain a hand on competition. And the second factor is that the market is becoming very competitive. You can see by the proxies on the crypto exchanges, for market concentration decreases over time with somewhere in mid-2017, becoming the point where the market became very competitive. It also increases on other layers of competition. For instance, for cryptocurrencies, there's an exponential growth, mostly of it motivated by initial coin offerings during this period. All right, regarding the data set, we use Keiko database, the fascinating data set with a coverage of over 100 crypto exchanges and providing data, granular level data at the trade level. And so we analyze 41 major crypto exchanges, in which one of the pairs in the basic currency is a Bitcoin, Ether, or Tether. And that's covers over 90% of the overall reported trading volume. We also rely on auxiliary data sets for exchange characteristics. We also take web traffic. This could be a proxy for demand. Code revision at the platform level, which could be a proxy for transparency, and social media data, also another proxy for demand. We also rely on initial coin offerings data. This is from another paper I have with Leandres and Palazzo. All right, so let's cover the summary. I'll just give some glance of some information here. For instance, the data coverage on the Keiko overlaps with CoinMarketCap, which is the largest price data provider, on average 87% of the time, which is quite good. So that mitigates our concerns with generalizing our results. Currency pairs enter the market on average over 50 new currency pairs per month, and exit about 10 currency pairs per month. That's very dynamic competition going on here, which we exploit in the paper. And a new crypto exchange enter the market every 2 months. So this is just to give you some example on how fake volume looks like once you plot it. On the left-hand side, you can look at OKEx in the same pair in a period of time with Binance, on the top volume and on the bottom trades. And you can see that Binance plots on the 10-minute bucks looks pretty much natural. However, if you look into the OKEx, that's this format, we call it shapes on blocks. It seems very artificial. We also perceive other types of shapes that could be associated with fake volume, such as peaks, and also such as noise. This is a particularly very interesting one because this is a very illiquid pair. If you see for Binance, there's almost nothing going on here. However, on Huobi, it seems that the whole universe start trading on this particular liquid pair. Now, there's no direct measure for fake trading, so we rely on someone is with the microphone open. All right, thank you. So we rely on indirect measures and statistical measures. It's great that Chidi covered very well what the Binford law is and deviation from it, because we also use that on our paper, but we also use other measures, including one which is very interesting. We borrowed that for computer science, and is a machine learning algorithm that looks in the structural breakouts in the time series. That makes no assumption on the distribution. It's very interesting. We have the well explained on our appendix for those that are interested. Take a look on how we apply and use those measures. Now, since these measures individually, they have advantages and disadvantages, we take the principal components and use as our final measure for fake trade, as that's more robust measure and maybe applied in most instances. So here is how it looks like. We plotted the evolution of fake volume on measures based on volume series, trade series, and combined. And you can see that the fake volume evolves throughout time, mostly through start increasing in 2016, then a sharp increase in 2017, pushes back in a U shape, goes high and stabilizes. This is an overall increase of 1 standard deviation fake volume throughout the period, and that's substantial because those are the averages across all crypto exchanges in all 3 pairs. This U shape here is due to the Chinese ban, an event in which we exploit in the paper you're gonna see in a moment. Well, once creating and generating the fake volume measures, we want to validate them to see whether they make sense. And first thing we do, we exploit the heterogeneous characteristics across exchanges. And we see that measures of compliance, such as anti-money laundering and KYC, as those measures goes up on the exchange level, the estimates for fake volume goes down. Exchanges that are located in crypto-friendly location also tend to fake more volume. And measures for demand based on web traffic, on social media, they are inversely related to fake volume. And that's clear because an exchange that already has a higher demand does not have incentives to endogenously create fake volume. Also, the measure for transparency in the platform is inversely related to fake volume. So it seems that the measure we created here are picking the effects. We also do a series of validations that are in the paper. I'll show just one more. Here we look into the Chinese ban. It's China introduced a ban to cryptocurrencies in the mid-2017. Some of the crypto exchanges moved from other regions in the Pacific Asia, and we compare that to exchanges that were already in Pacific Asia, and we expect that exchanges that are moving out China, they are having a shock to their jurisdiction, and that negatively impacts fake volume, at least temporary. And this is what we pick in our difference analysis for this event, and also when comparing to Hong Kong as a control group. All right, so having validated those measures, let's talk about competition. I'm happy I'm still talking, which means I still have some couple of minutes left. All right, so let's look into the static competition, how that works. So the overall level of competition in the market, how this is associated with fake volume. We have two measures. First is the number of exchanges that a particular currency is listed on. As this number increases, there's a positive correlation with the fake volume. And also we use market concentration. Overall, the static competition measures, they are increasing, fake volume is increasing in competition. There are several results here. I'll show one more and then move on. This is a very interesting one because it shows that at the exchange level, if an exchange is already beating a large portion of the shares in the market, and then there's no incentives to fake volume. Great. So let's look at another analysis we do for dynamic competition. Here we can see that when we increase the level of competition in the market, also the level of fake volume increases. So high competition, there's more fake volume, the moderate or low competition environment. And the dynamic feature is we analyze what is the response for a focal exchange at the currency level when a competitor enters with that same currency. Well, we see that the response is by faking more volume. When a competitor delists that particular currency, then the fake volume washes away. Okay, that was funny. Now, we also analyze for the high competition level, which is something that's more close to where we are right now, whether an entry is also picked by a response in the focal exchange. Oh, it does not seem to pick much here. However, when we treat those exchanges that are competing geographically, they're near in the same continent or near countries, then there's an additional level of fake volume as a response by the focal exchange. And also, if the competing exchange is competing operationally, then there's also a response. Great. So what are the consequences of fake trading? Why would the crypto exchange go to such trouble? Is it worth it? Let the crypto exchange decide. Here we show some empirical results. One standard deviation increase in fake volume in the short term is associated with 1.5 standard deviation increase in demand captured as web traffic. So there's way more visits to this exchange now. Of course, not all these visits convert to revenue, to new clients, but there's still a positive short-term impact on revenue. What does it happen when you move throughout time to 6 months, to 9 months? This estimates start decreasing and finally reverting. For the long term, that initial shock has a drastic effect, negative effect on demand and on revenue. So the bottom line for this particular analysis is for the crypto exchange in the short term, there are benefits. However, in the long term is associated with costs. This costs happening through the reputational channel. All right, let me conclude now. In summary, we examined the effects of competition among crypto exchanges on their incentives to inflate fake trade and fake volume. We show that volume inflation increases with competition, both statically and dynamically. In the short run, it seems that for exchanges are able to mislead customer. However, they are punished in the long term through reputational costs. Although we use a unique setting, our contribution is quite general. to finance industrial organization. For the crypto literature, we joined the nascent literature examining the behavior of crypto exchange. We just saw Shili presenting her paper. We also have an interesting paper for those interested in learning more about crypto exchange and fake volume, Alush and Lee, and other papers examining the behavior of crypto exchanges. So that's my talk. Thank you very much. I'm looking forward for the comments.
Great, thank you, Daniel. And again, we're going to take comments after the final presentation and in the breakout room or in the chat. Our final speaker is Sarit. Please, the floor is yours. You are muted.
Okay, I'm muted. Sorry, I am going to be using two devices here. So thank you very much. And I'm excited to be here, and very, very interesting talks yesterday, today. I'm going to talk about transparency and learning evidence from DeFi markets, and this is joint work with Dunchi and Valerie. They're both listening here. So just a little bit of motivation. When we think about most financial markets, then most financial markets are opaque and they really exhibit asymmetric information. This is why typically when we think about regulators are going to aim at transparency, and they hope to really increase market efficiency. And while some markets are more transparent than others, we still don't really know how exactly investors, traders, how do they behave in a fully transparent market? And specifically, do they really take advantage of all the information that is out there? And this is where DeFi markets actually give us a great opportunity, because we have this transparency. We know that all activity is available to all and in real time. And we specifically take advantage of the MakerDAO decentralized lending protocol in order to ask two questions. The first is, does transparency enable users to really identify winners or losers, or can we actually really identify those that perform better than others or worse than others? And really think about, okay, so what are the indicators that might inform traders of again, superior or inferior performance? And then if we do have those indicators, then do we actually see that traders really use this information in order to follow the winners? Okay, so just a very quick preview of our results. What we find is that, yeah, the information is out there. If you do want to identify superior or inferior performance, you can. Specifically, we find cross-sectional persistence in traders' ability to generate returns, meaning that traders that generate higher returns than others in one loan tend to also generate, or more likely to generate, higher returns than others in their next loan. But that also goes in the other direction, meaning that if we're thinking about liquidation, so if your loan is being liquidated, if we're thinking about it as an inferior performance, then those who had their loan liquidated are going to be more likely to have their next loan liquidated is there as well. So again, the information is out there, and if I want to look for indicators of superior or inferior performance, then I'm able to do that. So if we're looking at, so do traders really follow these winners? What we see is that the answer is no. So we find no evidence that traders with higher returns actually attract more followers. So traders that are going to imitate their investment strategy and do what they are doing. However, we do find that traders that tend to avoid the losers or those with inferior with inferior performance, meaning that really if we're looking at traders with liquidations, then others are less likely to follow them. And obviously the obvious question is why. So what's the intuition behind it? And we believe that the intuition really has to do with the fact that transparency is just by itself is not enough. So if we're thinking about the blockchain, if we're thinking about DeFi, then and if you want to imitate others, that means that you have to download this information. That means that you need to analyze it. That means that timing is going to be important. So in a way, it requires some sophistication that the average trader probably does not have. However, when you're thinking about liquidation, then this is actually pretty easy to identify and in a way consume information. And this is why we see that traders do use liquidation to avoid those with inferior performance, but they're not using all of the other information that can help you calculate and figure out whether some investors, some traders are doing better than others. So we're building on a very large and developing literature. I'm not going to get into that, and we kind of again, I think that this conference is giving a lot of these papers and research and teaching us a lot. So I'm going to start with thinking about the Maker protocol. So the Maker DAO protocol is just a set of smart contracts that is deployed on the Ethereum blockchain, where during the time of our sample, basically what you could do was to deposit ETH, and in return, you're going to get DAI, which is the MakerDAO protocol stable coin, and it's pegged to the US dollar. And it is public and permissionless. Loans are over collateralized, and it is decentralized. So anyone who wants to take a loan can take a loan. And this is why they actually require that you over collateralize your loan. And during the time of our sample, and it's still true today for MakerDAO and also other decentralized lenders, that the requirement is that your loan is going to be collateralized or over collateralized in 150%, meaning that if you want to borrow 100 ETH, that means that you have to deposit 150 ETH. You have to lock it in a contract, and then you're able to borrow this 100 ETH. And if at some point your wallet, your contract is going to be under collateralized, meaning that you are below the 150% limit, then your wallet is going to be liquidated, and you're going to be charged 13% fee. And again, they're going to kind of like close your wallet. So that's these are the liquidations. Now we have data directly. We downloaded data directly from the MakerDAO's API. And we have data on all contracts from December 2017 to May 2020. We have all the transactions on the MakerDAO protocol. And I think that kind of like a very important question is, I'm trying to think about trading and investment strategies, but I'm using lending data. So why do we use lending data in order to think about investment strategy? Well, the reason that we do that is because during the time of our data, this is really, you want to think about it as a time before SushiSwap and before Uniswap, and what investors actually used those lending protocols for is for leverage trading and for looping, where basically what traders would do is that they're going to borrow, so they're going to deposit ETH, they're going to borrow DAI, convert it to ETH, and then deposit this again in order to borrow some additional DAI, and then convert this to ETH, and so on and so forth, meaning that what you're trying to do is you're trying to increase your exposure to ETH. And we have here an example, and what we see here is that we have this trader opening the contract and then placing collateral in ETH, which is the DAI equivalent, and then borrowing 5.5 DAI, and then adding some additional ETH in order to deposit some more collateral, and then borrow some more, add some additional of their own money in order to deposit collateral, and then they are taking here a loan. Now they're taking this entire loan and depositing it in order to take some more money, and then at some point they are repaying the loan with the interest, and that's kind of like, that's the end of this loan cycle. Okay, so the idea is that, again, what you're using it is not really as a borrowing device that we see in traditional markets, but this is more of a trading kind of like tool. So we're going to try and calculate and think about, okay, so what is the return on a loan? And basically the return on a loan is going to be kind of like whatever is collateral is going to be left on the in your account, and then any kind of cash that you have minus what you put in over what you put in. So I'm not very, I'm going to go over this very quickly. I can talk more about that in the breakout room later on. But basically, going back to the example that I just showed you, thinking about this example, if we do the calculation, we can see that in this example, the return is going to be about 0.5%. Okay, so this is how we're looking at the return of the loan. And now what we are, for the first question, we're first trying to see, okay, so do we see any kind of persistence in performance? Because that's going to inform of higher or superior performance. And what we see is that, yes, when we are running the return on a loan as a function of your previous loan, then we see that, yes, and kind of like, a bunch of controls, then what we see is that, yeah, there is definitely persistence. We find persistence in return, where last loan return positively really predicts current loan return. And specifically, we find that the one standard deviation increase in your last loan return is going to increase your next loan return by 3.6%. Okay, and if we're thinking about liquidations also as an indicator of performance, but actually of an inferior performance, then we see that this is also indicative, meaning that there's also persistence in liquidation events. So if your previous loan got liquidated, then your next loan, your current loan, is more likely to get liquidated as well. And specifically, what we find is that previous liquidation increases the probability of current liquidation by almost 30%. And we also see that overall this persistence of returns really increases with experience, meaning that if you took more loans, then you are getting better at it. So there is, so the information is out there, right? The information is out there. The question is, do traders actually follow winners? Are they using this information? And the way that we're thinking about following is that if we're thinking about, we're going to think about the loan cycle as our investment, and we're going to say that a trader is following another trader's investment strategy. When we're thinking about a loan cycle, the trader is really following at least half of the actions that the initial trader actually performed. So if you took some more, if you borrowed more, then followers are going to also borrow more, and that your activity has to be at least 15 minutes or at most 15 minutes after the activity of the focal trader. So, and then we're going to count how many traders actually follow your activity. So that's our following measure. And now what we do is that we're trying to see whether the number of followers is actually positively correlated with your with traders' previous returns. That is, our traders that have higher returns, do we see that they attract more followers? And as you can see here, we find no evidence of that. However, we do find evidence that traders are avoiding those with liquidation. So when we're looking at our following measure, then we see that it is negatively correlated with liquidation. So if your previous loan got liquidated, then you're going to be less likely to be followed. And specifically, we find that the one standard deviation increase in the number of liquidations decreases the number of followers by almost 1%. So again, the question is why? So what's the intuition behind it? And we really believe that calculating a wallet's return is actually really complex and very costly for the average investor. And while liquidation events are just much easier to observe. And in order to test this hypothesis, what we do is that we're looking at the launching of a website. So in December of 2018, the MakerDAO Foundation, they launched a website that provides loan information data in a very, very clear and easy to consume way. And what we're doing is that we're looking at, okay, so do we see that following the introduction of this website, so now that it's much easier for you to consume and analyze information, does this actually change followers' behavior? And what we see is that, yes, in the case of return, there is still kind of like no effect, because still it requires a lot of calculations and downloading the data and so on. But in terms of liquidation, what we see is that before the launch of the website, there is just no correlation. However, it is really after the launch of the website when finding liquidated wallets is easy for me to do, is when we see that traders start to avoid those with liquidated loans. So I am just in time. I'm going to conclude by kind of like really thinking about policy with policy implications. And we believe that basically what regulators might want to take away from our result is that really transparency by itself is not enough. Information really should be given in an easy to collect and process way. So policymakers should really aim at the provision of easy to access and digestible information rather than transparency per se. That's it. Thank you very much.
Great. Thank you, Sarit. And thanks again to Xi and Daniel for this great session. Hannah?